Hey, how's it going, guys? Welcome to the Module 2 of Technical Analysis Foundation, the complete professional trading course for beginners. There are 5 sub-modules in this Module 2, which will cover 5 very important topics on chart reading. After completing the entire module, you will be able to analyze any price charts and retrieve the information you need for your trading. In this video, we will start from the Module 2.1 and talk about the fundamental principles of chart reading. Before we jump into the chart reading, we need to ask ourselves one simple question. What exactly moved the price? If the price doesn't move, then there will be no chart for us to read. In any market, there are two groups of participants, the buyers and the sellers. The buyers anticipate the price will go up in the future, so they're waiting to buy at the current price and wait until the price go up and sell to make a profit. On the other hand, the sellers believe the price will go down in the future, so they're willing to sell at the current price right now before the price goes lower. You can think about the buyers and the sellers work as two opposite forces in the market fighting each other at the opposite directions. When there are more buyers wish to buy at the current price, the market will respond to this stronger buying power. The sellers will raise their offer price as they realize that the demand for this market increases and they can sell at an even higher price. Therefore, the price will go up. On the other hand, when there are more sellers with large sell orders hitting the market will respond to this stronger selling power. The buyers realize the supply of this market increases, so they are willing to wait for the price to go lower and take the sell orders at a much cheaper price. In that case, the price will go down. There's only one reason that market price moves. It is the imbalance between buying and selling pressures. That's it, nothing more. In technical analysis, every trading edge we have as technical trader comes from an imbalance of buying and selling pressure. In the real world, buying and selling decisions are made by humans at some certain specific times and price levels. So the market does have a memory. That's why we frequently see non-random price actions retesting some of the important price levels. Buying and selling pressure will leave readable and repeatable patterns in the market. This is one of the sources where our trading edge could come from. However, please remember this. We do not trade patterns in the market. Instead, we trade underlying imbalances that create those patterns. Alright, once we understand what moves the price, let's move on to the price chart. So what exactly is a chart? This is a daily chart of S&P 500. I randomly screenshotted from my TradingView. When you look at this chart, what information does it tell you? What does a chart mean to you as a technical trader? Let me share with you what does a chart mean from 3 different layers and perspectives. Number 1, a chart is nothing more than a tool to display market data in a structured format. Once traders learn how to read the messages from the market, they can understand the psychological trend and the imbalance between buying and selling pressure at any given point. Number 2, a chart is a roadmap of human behaviors and emotions in the market. It provides you the path to anticipate what the majority will do next. Number 3, which is also my favorite, a chart is a visualized collection of market players' anticipation to the near future. It is important to understand what can a chart do for you from these 3 perspectives. Next, there are 4 general principles of chart reading. First, clarity. You should always focus on price candles and the market structures before anything else. Second, simplicity. When you see a chart, you want the price bars to be the first and the most important thing your eyes are drawn to. Tools that highlight the underlying market structures, okay. However, anything that distracts you from the focus should be avoided. Consistency. You need to use similar consistent approach to analyze different charts. It saves your time and gives you more efficiency. Also, it's super important for the development of a trader because a part of your learning process as a technical trader will be training your eyes and the brain to process data in a fast and efficient way. One of the core skills average professional traders has is the ability to process mass amount of data in a very short period of time and make quick decisions. Suitability. There's no holy grail of so-called best chart settings, time frames, and technical indicators. Professional traders find a combination that suits their style and works best for them. Here are some of the useful chart reading tips. The first is on chart scaling. You may notice that on your chart reading software, there are two types of charts, linear chart and a log chart. As a rule of thumb, you should always use linear chart, but with only two exceptions. One, anytime you have greater than 100% price increase on a chart. Number two, any chart showing more than 2 years of data. In these two scenarios, you should use a log chart. The second is on multiple time frame. Nearly all the professional traders analyze price charts on multiple time frames, although they do it in different ways. A higher time frame is often used to confirm a trend is forming, where a lower time frame can be used to find a precise entry point. In general, different time frames should be related to each other by a factor of 3 to 5. For example, if your main time frame is a daily chart, then a 4-hour chart should be your ideal lower time frame chart compared with a 5-minute chart, for example. Alright, so here are the 4 key areas to help you read a price chart like a professional trader. There are candlestick patterns, support and resistance, moving averages, and technical indicators. In the next 4 sub-modules, I will go through each one of them in details with real market examples so that you guys can apply these techniques in your own trading. Legendary trader Paul Tudor Jones once said, "The whole world is simply nothing more than a flowchart for capital." One of the key differences between successful traders and the average traders is that the successful traders see themselves as the market makers instead of just participants. They see the market in a whole new and a much higher perspective. Average traders see price up and down, while successful traders see the underlying supply and demand. If you learn how to see the market as those legendary traders do, you will never be the same again. Alright, thanks for watching guys, and I will see you guys in the next module. Bye for now.